If you're living in the GCC, and especially if you have been here for a few years, there is one investment that almost everyone talks about: real estate. Someone always knows someone who bought in Dubai Marina 10 years ago and made a fortune. Someone else is talking about the rental yields. Someone is showing you the brochure from the latest off-rent launch in Business Bay. And this makes sense. Real estate is tangible. You can see it, you can walk through it, you can rent it out. There is something very reassuring about owning a physical asset. So what I want to do today is put real estate and structured notes side by side. Not to tell you which one is better than the other, but to give you the full picture on both, the good and the not so good. Let's start with why people love real estate here. And there are genuine reasons. First, capital appreciation. Dubai has had periods of very strong price growth. If you bought in the right location at the right time, the returns have been exceptional. People talk about doubling their money, and some of them are not exaggerating. Second, rental income. Gross yields in Dubai are often in the range of 6 to 8% per year. Compared to London, compared to Singapore, compared to most major cities in the world, that is attractive. And third, and I think this one is underestimated, there is something psychologically very powerful about owning a physical asset. It feels permanent, it feels safe. For a lot of people, it is also a statement, a milestone. Now I want to be fair here, because the number most people quote, the rental yield, is the gross number, not the net number, and the difference matters. When you buy a property in Dubai, you pay a 4% Dubai Land Department fee on day one, plus agent commission, typically around 2%. That is 6% in entry cost before the property has done anything for you. What this means is your property needs to appreciate by 6% just to break even on capital, and then separately every year. Service charge, maintenance, vacancy between tenants, and if you are using a property management company, which many investors here do, that is another fee, typically a percentage of your annual rent taken off on the top. These costs eat into your rental income. So the 6 to 8% gross yield that most people quote, the net number after all of this is often closer to 4 to 5%. Now I want to be fair again. 4 to 5% on a tangible asset in a growing city is not a bad outcome, but it is not the same number you started with. And then there is the question of timing. Dubai real estate has had very strong cycles. It has also had very difficult ones. If you bought in 2014, for example, you went through several years of declining prices before the market recovered. The timing matters enormously, and timing is something none of us can control reliably. There is one more dimension I want to mention, and this one rarely comes up in these conversations. Any physical asset, whether it is in Dubai, in London, or in Singapore, carries a degree of geopolitical risk. If there is instability in a region, liquidity in the property market dries up very quickly. Buyers disappear, transactions slow down, and the one thing you cannot do with a building is move it. This is not a reason to avoid real estate, but it is a risk worth knowing that. Now let's look at the other side of this comparison, structure notes. Let me start with returns. With a structure note, your potential return is defined before you invest. You know the coupon, you know the conditions, you know the tenure. There is no guessing, there is no waiting to see what the market does this year. For argument's sake, let's say you invest $500,000 into a structure note with an 8% annual coupon paid quarterly. That is $40,000 per year coming into your account. No tenants, no service charges, no vacancy periods, no management company, no overhead, no property to run, and the entry cost, there is no transfer fee, no agent commission. You are not starting 6 months behind on day one. Now let us talk about liquidity. If you need to sell a property in Dubai, you are looking at a process that can take several months. You need a buyer, you pay fees, and in a soft market, that process gets even longer. With a structure note, there is a secondary market. Now all structure note comes with a guaranteed buyback by the issuer, meaning if you want to sell before maturity, you can do so. The risk here is that you sell at the market price or NAV, which could be lower than the buying price, and you can liquidate within a day or two. And one more thing on liquidity, a structured note does not have a postcode. If something changes in your life, if you want to move, if you want to relocate, your investment moves with you. A building does not. A structured note is not a physical asset. There is nothing tangible behind it. It is a financial instrument issued by a bank, and the first thing you need to understand is the risk inside a structured note depends entirely on how it is designed. A 100% capital protected note is a very different instrument from one where your capital is linked to market performance. Every note is different, and that is why reading the term sheet carefully is not optional, it is essential. What every structured note has in common, regardless of how it is designed, is counterparty risk. If the issuing bank runs into serious trouble, you are an unsecured creditor. We covered the Credit Suisse situation in video 4, and finally, capital appreciation. A structured note is not designed to give you capital appreciation. If the market doubles, the note will not double with it. The note is designed for defined income and defined protection, not for capturing unlimited upside. This is a fundamental difference from real estate. Real estate gives you a tangible asset, potential capital appreciation, and leverage. If you use financing, the costs are high at entry. The yield is often lower than it appears on paper, and the liquidity is low. A structured note gives you defined returns, lower entry levels, better liquidity, and engineered downside protection. So now we come to the real question. Not one which is better, but what are you actually trying to achieve with this capital? Because these are two different tools, and different tools are built for different jobs. If you're looking for a long-term asset that builds generation wealth and that you can pass on, that gives you leverage through financing and has the potential for significant capital appreciation over time, real estate makes sense. That is what it is designed for. If you're looking for defined returns with a full clarity on your downside before you invest, with liquidity and no management overhead, a structured note makes sense. That is what it is designed for. The mistake most investors make is treating these two as competitors. They are not. Real estate and structured notes serve two completely different purposes in a portfolio, and a well-constructed portfolio needs both. Real estate does things structured notes cannot, and structured notes do things real estate cannot. That is the point. Real estate gives you tangible asset, capital appreciation potential, and the ability to use leverage. A structured note gives you defined income, liquidity, and a clear outcome from day one. Now here is something I see very often with investors in this part of the world. A very large portion of net worth sitting entirely in real estate. And on paper that looks impressive, but there's a difference between being wealthy on paper and being rich in cash. You can own multiple properties and have very little flexibility, very little ability to move quickly when an opportunity appears. And that is not a position of strength. That is a concentration risk. The goal is not to choose between real estate and structured notes. The goal is to build a portfolio where the both are working for you, each doing what it does best. So this is what I want you to take away from this video. Real estate is a powerful asset class. Nobody is disputing that. But like every asset class, it has got cost, it has risk, and it has limitations that are worth understanding clearly. The structured notes are not replacement for real estate. They are a different instrument entirely with a different purpose, a different risk profile, and a different role in your portfolio. The question was never which one is better. The question is always what your money is supposed to be doing for you. In the next video, we are going to talk about what determines the structured note returns. Because once you understand how returns are constructed, everything else about those instruments starts to make a lot more sense. If you have questions, feel free to reach out, and if you found this useful, I will see you in the next one.